Most people don't lose money in investing because they are stupid. They lose money because of something much worse, something they don't even realize is happening. It's not the market. It's not the economy. It's not bad luck. It's their own brain. Last video, I left you with something uncomfortable. The biggest risk in investing isn't the market. It's you. Today, we're going to prove it. And once you see this, you won't be able to unsee it. Welcome back to Money with SULLY, where personal finance actually makes sense. Yeah, still a pun, still not apologizing. Think about this for a second. Have you ever sold an investment and then watched it go up right after? Or bought something just because everyone else seemed to be making money? Now here's the scary part. You probably knew it was a bad idea, and you still did it. That's not a knowledge problem. That's a behavior problem. Because in investing, knowing what to do is easy. Doing it is where almost everyone fails. There's a field called behavioral finance, and its whole point is this. People don't make financial decisions rationally. Classic economics assumed people were logical, cold, calculated, like little robots with their spreadsheets. They were wrong. Real people panic. Real people get greedy. Real people make decisions based on fear, hope, and what their friend told them at a barbecue. Today, we're looking at the 6 cognitive biases that quietly destroy investment returns. And then, because I'm not here to just depress you, we're going to talk about how to fix each one. Bias number 1. Loss aversion. Here's the science. Losing $100 feels about twice as painful as gaining $100 feels good. Let that sink in. The pain of loss is psychologically twice as powerful as the pleasure of gain. So what does this do to investors? 2 things, and both are bad. First, we hold on to losing investments way too long, because selling means admitting the loss is real, and our brain refuses to do that. So we hold and hope and watch it keep going down. Second, we sell winning investments too early, because locking in a gain feels safe, feels smart, but we cut the winners short before they've had time to grow. So we cut our winners short and let our losers run wild. Exactly the opposite of what successful investors do. There's a famous rule: cut your losses short, let your winners run. Simple? Yes. Easy? Not at all, because your brain is wired against it. And when the market drops, it gets worse. Imagine your portfolio is down 20%. Headlines everywhere. People panicking around you. Your brain tells you, get out now, before it gets worse. And in that moment, selling feels like the smart move. It feels like control. It feels like safety. That wasn't a strategy. That was fear wearing a suit. Because the second you sell, you turn a temporary drop into a permanent loss. And most people don't buy back in. They wait, they hesitate, they try to feel safe again. And by the time they do, the market has already recovered. Now let's talk about the full cycle, because loss aversion is just one side of it. Fear makes you sell at the bottom, but greed makes you buy at the top. You see a stock going up 20%, 50%, 100%. People are talking about it everywhere. Social media, friends, news. Everyone seems to be making money except you. And that feeling of missing out is incredibly powerful. The moment something feels too good to miss is usually the moment you should pause. But most people don't pause. They jump in right when the excitement is highest, right when the price is already inflated. And what happens next? It drops. Now fear kicks in again, and before you know it, you've completed the full cycle. Buy high, sell low, over and over again. Your brain is not designed for investing. It's designed for survival. Thousands of years ago, reacting quickly to danger kept you alive. If something felt wrong, you ran. No hesitation. But in the stock market, that same instinct works against you. Because a market drop is not a tiger. It's not a real threat, but your brain treats it like one. Your brain is trying to save you. At the exact moment, it's costing you money. Bias number 2, herd mentality. Be honest. Have you ever bought something just because everyone else is buying it? Of course you have. We all have. Because your brain says so many people can't be wrong. But in investing, the crowd is often wrong at the worst possible time. By the time everyone is talking about an opportunity, it's usually already too late. You don't arrive early to the party. You arrive when it's about to end. Music stops, lights turn on, and you're the one left holding the bag. Think about crypto in 2021. Everyone was buying, your neighbor, your cousin, that guy at the gym who doesn't even know what a blockchain is, buying. And then it crashed. Or think about 2008. Everyone was selling, panic everywhere. And the people who followed the herd, they sold at the bottom. The herd buys at the top, sells at the bottom, every single time. Warren Buffett said it best, be fearful when others are greedy, and greedy when others are fearful. Easy to say, very hard to actually do. Bias number 3, overconfidence. You make a few good investments, and suddenly you feel unstoppable. You start thinking like Warren Buffett. I figured this out. You increase your position sizes, take bigger risks, stop questioning your decisions. Studies show that most people think they're above average drivers. Mathematically impossible, but here we are. The same thing happens in investing. Most amateur investors think they can beat the market, pick the right stocks, time their entry and exit perfectly. Spoiler, they can't. The data backs this up. The more actively people trade, the worse their returns get. Transaction costs, taxes, and mostly bad timing driven by overconfidence. The market has a way of humbling people fast, because usually the biggest losses happen right after your confidence peaks. The irony, the investors who think they know the most are often the ones who do the worst. A little humility goes a long way in investing. Bias number 4, recency bias. Our brains are wired to give more weight to recent events than older ones. Makes sense evolutionarily. If a lion attacked you yesterday, you should probably avoid that area today. But in investing, it causes expensive problems. When the market has been going up for 2 years, people assume it'll keep going up forever, so they pile in right at the top. When the market has been going down for 6 months, people assume it'll keep going down forever, so they sell right at the bottom. Recency bias makes you extrapolate the recent past into the infinite future, and the market doesn't care about your extrapolations. The fix? Zoom out. Stop looking at daily charts. They're noise. Look at the long term, because the difference between panic and patience is perspective. Bias number 5, confirmation bias. This one's sneaky, really sneaky. Once you invest in something, you're no longer objective. You become emotionally attached. Now you only look for information that proves you're right. Bad news, it's temporary. Negative opinions, they don't understand. Positive news, I knew it. At that point, you're not analyzing anymore. You're defending your decision. So you hold on to bad investments way too long. Not because you don't have information, but because you only process the information that supports what you want to believe. Here's the uncomfortable part. We all do this, all of us, including me. The question is, are you aware of it? Bias number 6, impatience. Everyone wants to make money fast, but investing isn't fast food. It's slow cooking. It takes time. But what do most people do? If an investment doesn't move in a few days, they sell. Then what happens? Right after they sell, it goes up. And they say, of course, it only goes up after I sell. But the truth is simple. They didn't give it time. There's a quote that I love. The stock market is a mechanism to transfer wealth from the impatient to the patient. If you can't wait, you can't win. And here's the painful irony. The investors who check their portfolios the least, who think about their investments the least, who do the least, they often outperform the ones who are constantly busy. Doing nothing is a skill, and most people are very bad at it. So we've got 6 biases: loss aversion, fear and greed, herd mentality, overconfidence, recency bias, confirmation bias, impatience. And here's what they all have in common. They feel completely rational in the moment. That's what makes them so dangerous. When you're panic selling, it doesn't feel like panic. It feels like logic. It feels like protecting yourself. When you're following the herd, it doesn't feel like herd mentality. It feels like common sense. This is the enemy within, not the market, not the economy, not interest rates. You. Your brain, the most sophisticated computer ever built, is working against your financial future. And the first step to fixing it is simply knowing that it's happening. Let me tell you a quick story. There's a guy, let's call him Alex. One day he sees an investment trending on social media. Everyone's talking about it. This is going to the moon. Alex thinks, why not me? So he invests $1,000. Day 1, it goes up. He's excited. Day 2, drops a little. That's normal. Day 3, drops more. I'm in it for the long term anyway. Day 4, crashes hard. Now he's nervous. Day 5, panic. He sells at the bottom. A week later, it recovers. Classic. Not because Alex is stupid, but because Alex is human. Okay, enough doom. Let's talk solutions. 6 biases, 6 fixes. Fix 1, for loss aversion. Remind yourself that a drop is not a loss until you sell. Paper losses are temporary. Realized losses are permanent. Your job is to stay invested, not to feel comfortable. Fix 2, for fear and greed. Build a system. A system doesn't care how you feel. It doesn't panic. It doesn't chase hype. It just follows rules. Invest the same amount every month, no matter what. No thinking, no guessing, no emotions. You don't need to be smarter than the market. You just need to be more consistent than your emotions. Fix 3, for herd mentality. Have a written investment plan before you invest. When everyone's panicking, you need something to anchor you. A written plan keeps you from following the herd in moments of weakness. Fix 4, for overconfidence. Default to simplicity. Index funds, consistent contributions, long time horizon. If you find yourself thinking you figured out how to beat the market, that's a red flag, not a green one. Fix 5, for recency bias. Zoom out. When the market is down, look at a 20-year chart, not a 3-month chart. Context is everything. The recent past is just a blip on a very long story. Fix 6, for confirmation bias. Actively seek out the opposing view. Before any investment decision, find the strongest argument against it. Read it seriously. If you still want to proceed, fine, but at least you've stress tested your thinking. And for impatience, stop checking your portfolio every day. The more you look, the more you feel the ups and downs, and the more you feel them, the more likely you are to react emotionally. Check it monthly, quarterly. Give yourself some distance from the noise. Here's what it all comes down to. The biggest battle in investing is not against the market. It's against yourself. Learning charts is easy. Controlling your emotions, that's the real skill. The winners are not the smartest people. They are the most disciplined. It's not about knowledge. It's about behavior. And changing behavior is the hardest thing a human being can do. But awareness is the first step. You now know the 6 biases. You now know the 6 fixes. And once you control your psychology, you change the game completely. If this video clicked for you, hit that like button. Subscribe if you want more. Which of the 6 biases do you struggle with most? Drop a comment. I read every single one. Yes, actually. I'm Sully. Thanks for watching. If you found this valuable, feel free to like, comment, and subscribe.